I'm Greg Hunter. Welcome to USAWatchdog.com. With us, a best-selling author, a financial expert, a lawyer, a Wall Street insider, someone that the U.S. government has hired to play financial war games. I'm talking about the author of this brand new book, The New Case for Gold. If you can see at the bottom there, you can see it's James G. Rickards. He is a best-selling author of Currency Wars and this book, The Death of Money. He's probably going to go for the hat trick. It's very rare for a first-time author to have two best-selling books going on his third. James Rickards, thank you for joining us today on USAWatchdog.com.
Greg, thanks for inviting me. It's great to be with you.
Well, I'm a big fan of yours. A lot of people are big fans of yours. Obviously, you have best-selling books. But I want to talk about the 21st century reasons for buying gold, that it's not an old relic, that there is enough gold in the world if the price is high enough. And one of the things has to be a calamity. You have said in the past that all we're waiting for is a snowflake moment. You think a collapse is coming. Let's start there. For a good reason to own gold, tell me why you think a collapse is coming, and what does it look like?
Well, you're right, Greg. First of all, there are plenty of good reasons to own gold without a calamity, without a collapse. But to address your question, yeah, look, when I say collapse, it's not the end of the world. It doesn't mean we all go live in caves. What it means is that the international monetary system collapses, which could basically involve a loss of confidence in existing central bank money. When I say that, it's not like it's never happened before. It's actually happened 3 times in the past 100 years. Go back to 1914. What happened then? On the eve of World War I, countries suspended gold shipments. The New York Stock Exchange was closed for 5 months. Imagine that. The New York Stock Exchange was closed for 5 months from July to December 1914. So that's what I mean by a collapse, when the system just ceases to function. Same thing in 1939. Same thing in 1971. Okay, the stock exchanges didn't close, but the world was in turmoil. We had borderline hyperinflation, 3 recessions in 8 years between 1973 and 1981. So that's what I mean by collapse. But what happens, as I say, it's not the end of the world. What it means is that the major trading and financial powers get together, sit around a table, and they rewrite what they call the rules of the game. They come up with a new system. And so what I'm trying to do is, first of all, foresee the collapse, forecast the collapse, and warn people about it. Number 2, look forward and see what the new system will look like, and then come all the way back to the present and say, what can you do today with your portfolio and your investments to prepare for what's coming? So that's basically the analysis. Now, why do I say collapse? And I've also said, and it's very clear, and I think you can prove this scientifically, that the next collapse will be bigger than anything in history, at least maybe since the end of the Bronze Age or the fall of the Roman Empire. There have been a couple of big collapses, 1,500 years apart in the last 3,000 years. But we don't have to hypothesize that. This will be bigger than anything that any of us can recall. Why do I say that? Because I use complexity theory. I use something called inverse probability-based theorem. I use behavioral psychology. These are the scientific methods. When I say scientific, I mean this is applied mathematics, experimental psychology, a branch of physics. This is hard science to understand capital markets versus the obsolete models that the Fed and other central bankers are using. They're using what they call stochastic general equilibrium models. It's almost like, the clock winds down, you crank it up, it gets back on time again. Something gets out of balance, you apply policy, you bring it back into balance. Or imagine a thermostat, your house is too warm, you turn it down, your house is too cool, you turn it up. Those are all examples of equilibrium systems. Capital markets are not equilibrium systems. They are complex systems. And so when you apply complexity theory, you learn a couple things. Number 1, the worst thing that can happen, so this is the collapse we're talking about, is an exponential function of scale. When I say exponential, what I mean is it doesn't go up in a linear way. So let me give you a concrete example of that. So let's just take J.P. Morgan. Let's say from 2008 to 2018, let's say, 10-year period, so a couple years out, you've tripled the balance sheet, hypothetically. So you go to Jamie Dimon, the CEO of J.P. Morgan, and you say, Mr. Dimon, you've tripled your balance sheet. How much did the risk go up? He would say very little, almost none. And the reason is, yeah, we tripled our balance sheet, but it's long, short, long, short, long, short, long, short. All those things net out. The actual net risk is quite small. We have it under control, so there's very little risk at all. If you call my 85-year-old mother, who's a brilliant woman, but not an economist, not a complexity theorist, and say, Mom, the bank tripled their balance sheet, how much did the risk go up? My mother would probably use intuition and say, well, if you triple the balance sheet, you triple the risk. Jamie Dimon's wrong and my mother's wrong. In a complex system, when you triple the size of the system, the risk increases exponentially. It could be 10 times, 50 times, 100 times. In other words, there's all this embedded risk. The risk in derivatives, the risk in a balance sheet is not in the net the way Jamie Dimon would have it. They call that value at risk. The risk is in the gross. If your counterpart's going bankrupt, you don't care what your net exposure on your total balance sheet is. You care about your gross exposure to that particular counterpart. That's why the Fed bailed out AIG in 2008, because they didn't really care about AIG, but they owe Goldman Sachs a lot of money, so they were indirectly bailing out Goldman Sachs. So just take everything I said. Now go back to 2008. What did we hear about over and over? Too big to fail, too big to fail, too big to fail. Guess what? Since 2008, the 5 largest banks in the United States are bigger. They have a larger percentage of the banking assets. The derivatives books are much bigger. So again, putting those facts and the science together, what we can see is that everything that was too big to fail in 2008 is bigger today. Risk is an exponential function of scale, which means the risk is much bigger. And just to top off, the icing on the cake, all the bailout measures that were used in 2008, the Fed printing $4 trillion, creating tens of trillions of dollars of swap lines, none of that policy has been reversed. The Fed still has the $4 trillion on their balance sheet. They still have the tens of trillions of swap lines in place. In other words, having used up all that dry powder to bail out banks the last time, they don't have any scope to do more. I mean, what's the Fed going to do next time? Go from $4 trillion to $8 trillion, $12 trillion? At that point, you're at the outer boundary of the confidence limit. So we have these things coming together. The system is larger. That means systemically it's exponentially more risky. The central banks don't have any dry powder, and it's just a matter of time before the collapse comes. And just to prove that point, go back to 1987, October 19th, 1987. The stock market fell 22% in one day, not a week or a month, but one day. Today, in Dow Jones index points today, that would be the equivalent of a 4,000-point drop. Now, you and I know that if the Dow went down 400 points, that would be on every website, front page news. That's all people would be talking about. We're talking about 4,000 points. That's the equivalent of that happened in 1987. 1994, the Mexican peso crisis. 1997, the Asian crisis. 1998, long-term capital management almost shut every stock and bond exchange in the world. 2000, the dot-com. 2007, the mortgage crisis. 2008, Lehman AIG. In other words, these events are not rare. They happen every 3, 4, 6, 8 years. It's not quite like clockwork, but nobody should be surprised if it happens tomorrow. So we've got the systemic scale. We've got the exponential increase in risk. The central banks are out of dry powder, and it's been 8 years since the last one. It's just a matter of time. So part of the reason for having gold is when this happens, the response function the next time is going to be very different. Last time they printed money to bail out the system, but they can't do that again because they never took the money back. Their balance sheets are still bloated. By the way, the People's Bank of China printed more money than the Federal Reserve. The ECB, the Bank of England, the Bank of Japan, they're all in terrible shape. All these central bank balance sheets look like really bad, highly leveraged hedge funds. So what are they going to do instead? They're going to do two things. You can already see this coming. The reliquification of the world, the money printing, is not going to come from the Fed. It's going to come from the IMF, the International Monetary Fund. They have the only clean balance sheet left in the world. They can print money too. They don't print dollars or euros. They print special drawing rights or SDRs. So they're going to flood the zone with trillions of SDRs, which will be highly inflationary. But the other thing that's going to happen, and again, you can see this coming, they're going to lock down the system. They're not going to bail out the banks. They're going to close the banks, close the exchanges, suspend redemptions in money market funds, reprogram ATMs so you can only get $300 in gas and groceries. It's going to look like Greece and Cyprus. By the way, last year the SEC changed the rules. For the first time, money market funds are allowed to suspend redemptions, which is exactly what hedge funds do in a crisis, but nobody ever thought you could apply that to money market funds, so they will. So the bottom line is the risk is exponentially greater. The central banks are out of dry powder. It's just a matter of time before the collapse is coming. Complexity theory tells us that. It'll be a bigger collapse than ever before. And the only rescue will come from the IMF, which will be inflationary, plus locking down the system, which means you won't be able to get your money. So my advice is get some gold now. Don't wait for the panic. Don't wait for the price spike, because you actually won't be able to get it when that buying panic kicks in. Get your gold now. Put it in a safe place. Gold is non-digital. Can't hack it. Can't erase it. Can't freeze it. So that'll get you through. That'll see you through the crisis.
I am guessing that the people, all the big sellers of gold and silver, for that matter, will be playing the market with their inventory. Now, I'm guessing, but you know this. What do you think will happen?
Greg, who are the big sellers? There are no big sellers. They're big buyers. The only people selling gold are miners. That's the business they're in. I just got back from Switzerland. I met with the head of the world's largest gold refinery. One of the complaints I have or criticisms I have about a lot of analysts is that, nobody gets away from their screens. Like, we love our screens. We love our internet. We love our news services. I mean, I spend as much time in front of the screen as anybody. But you have to get up and get out there, fly around the world and meet people. And that's when you really find out what's going on, particularly as regards to, in regard to gold. People watch the COMEX futures. They think that's the price of gold. They hear talking heads on TV or whatever, but I like to meet with the people who handle physical gold. So these are secure logistics operators, people who drive armored cars, operate vaults, bring out gold on pallets, physical gold. Also meet with the refiners, brokers who deal in physical gold. That's when you find out what's really going on. So as I said, I just got back from Switzerland about 10 days ago, met with the head of the world's largest gold refinery. What does a gold refinery do? They bring gold in the front door, they refine it, and they ship it out the back door, right? The gold comes in three forms. There's what's called doré, which is about 80% pure. It comes from mines. There's what they call scrap, which is, necklaces, bracelets, rings, etc. That's, 14 karat, 18 karat, or whatever. So, 60, 70% pure. And then there are 400-ounce bars, which are 2 nines, meaning 99% pure. They take all that gold, they refine it into what are called 4 nines. That's 99.99% pure, and they make it into 1 kilo bar. So the 4-9 1 kilo bar is the new global standard that's set by the Chinese. So basically, they take in doré scrap and gnarly old 400-ounce bars, refine it into 99.99% pure 1 kilo bars. But what does it mean for the refiner? He knows who all the sellers are, and he knows who all the buyers are. He knows where he gets his gold, and he knows where the gold goes. Now, what he told me is that he cannot keep up with demand. Basically, the Chinese want twice as much gold as he's able to send them. He sends China about 10 tons a week, so 500 tons a year. He's not the only one, of course. Other refiners are doing the same thing. China's buying a lot more than that. But he said China would double their order if I could supply it, but I can't. His problem is I can't find the gold. I can't get the gold in the front door. He's seeing continual shortages. He's been in the business 35 years. He's never seen anything like it. He can't source the gold. And he also told me that, a gold bar, a 400-ounce bullion bar, I've seen them. I've actually handled them. They're pretty heavy. One of those bars weighs 35 pounds. It's got all these stamps on it. It's kind of like a dollar bill. It's got the date. It's got a serial number. It's got an assayer stamp. The assayer certifies that it's pure. It's not counterfeit. It's got the stamp of the refinery, whether it's Johnson Matthey, Argo Horaeus, PAMP, whatever. So it's got all this information on it. Now, what he said was interesting. He said vaults in London store their gold on what's called a LIFO, or last in, first out basis. So they keep piling up gold, and the more recent gold is kind of near the front door. And then when they ship it out, they take the first bars first, right? So if you put a bar in 2007 and you want to take it out in 2016, that's the bar you take. He said, I'm seeing bars stamped 1980, dates in the 1980s. That means they're scraping the bottom of the barrel, right? Those bars have been in those vaults for 35 years. So they're getting to the end of those vaults. We know the COMEX vaults are bare. So basically what he told me bears out what we hear from other sources. It's all confirmed that London, New York, COMEX, others, the Federal Reserve actually, they're shipping out a lot of gold because it's going to Germany and other countries that want their gold back. So gold is disappearing. It's hard to get. Meanwhile, there's unsatisfied demand. Now, the reason I go through all that is because I run into a lot of people and they say, well, okay, I hear you, Jim. You make a good case. I ought to have some gold, but I'm going to wait until the danger signs are there. I'm going to wait until the system starts to fall apart, as you describe it. I'm going to wait until the price goes up, and then I'm going to go get some gold. Now, what I tell these people is no, don't wait, because you're not going to be able to get it. There are going to be physical shortages. When the buying panic breaks out, you're going to call a dealer, and they're going to say, sorry, just like my friend in Switzerland, I can't take any more orders. I'm back ordered. You're going to call the mint. They're going to stop shipping. You're physically not going to be able to get it. You'll be sitting there watching the price go up on television, right? $100 an ounce, $200 an ounce, $500 an ounce, daily price moves. That's what a buying panic looks like. And you're going to be saying, get me some gold, and you're literally not going to be able to get it. So We have a good entry point in the price. There is supply available, although it's getting scarce. The time to buy your gold is now. What are you waiting for?
Well, I wanted to. I'm sorry. I'm really into this. I want to talk about the dollar collapse. Will the dollar collapse when they lock the system down and stop people from liquidating their money market accounts and stuff like that? Will the dollar collapse in value?
Well, it's more the other way around. The beginning of the collapse will cause the lockdown. It's not that the lockdown will cause the collapse. The lockdown will be the consequence of the collapse. When I say collapse, it's basically a loss of confidence. So, by the way, this does happen, Greg. Let's just take the 1970s, okay? In 1971, gold was $35 an ounce. In 1980, it was $800 an ounce. That's over a 2,000% increase in 9 years. Now, that's one way to think about it, but that's actually not how I think about it. I think of gold as a constant. This gets into a mathematical term, a French mathematical term called the numeraire. The numeraire is just how you measure things, right? So I send two people out, and I want them to measure a football field. And I give one of them a 12-inch ruler, and I give the other one a yardstick. And I say, tell me how long the football field is. And they come back, and the guy with the ruler says it's 300 feet, and the guy with the yardstick says it's 100 yards. So is it 300 or 100? Well, it depends on your unit of measurement. So by the same token, people say gold went up, gold went down. Well, what they're really saying is the dollar price of gold went up or the dollar price of gold went down. But in that conversation, you're privileging the dollar. You're saying the dollar is the yardstick, in my example, or the dollar is the ruler. Why do that? Why are you privileging the dollar? Why is the dollar the measure of all things? You can turn it around, make gold the measure of all things, and say, okay, I'm going to think of things in terms of weight of gold. So 1 ounce of gold. Okay, so one way to describe it is, in 1971, a dollar was worth 1/35 of an ounce. In 1980, a dollar was worth 1/800th of an ounce. What really happened? Gold was constant, and the dollar went down 90%. See, that's the point. When you say the dollar price of gold went up, the way I think about it is that the dollar went down. Gold was constant and the dollar went down. So a skyrocketing price of gold is a collapse in the value of the dollar. That's what it is. That's how you can define it once you make gold the numeraire. And it's that collapse of confidence. And gold is like a thermometer. You see the patient. Is the patient healthy or is the patient sick? Or you put a thermometer in the mouth or take the blood pressure, right? So gold is your thermometer. Gold is the way to tell if the dollar is healthy or not. When you see a skyrocketing price of gold, don't pat yourself on the back and say, what a good boy am I, the price of gold's going up. You ought to be telling yourself the dollar is collapsing, and that's what I'm talking about.
You say that you make a case in your book for $10,000 an ounce for gold, and some people might go, but you, smart guy, and you say, listen, this is 8th grade math. Here's a reason why you can come up with $10,000 an ounce. Could you give us the 8th grade math and tell us how you come up with that price of that gold should be $10,000 or will be at some point $10,000 an ounce?
Yeah, I think it will be, and I think it'll be sooner than later, and it's easy to explain why. When you have this collapse of confidence that I just described, and we went through all the reasons for that, the scientific reasons, the complexity theory and scale, and we went through all that. Okay, so when that happens, you're going to have to restore confidence. How do you do it? Well, if the problem was, printing too much money and being cavalier about confidence in the dollar, printing money isn't going to save you. That's just more poison. Now, you might be able to reliquify the system with special drawing rights. There's no doubt that the power elite will try. And by the way, Greg, when I say the power elite, I'm not trying to conjure up some boogeyman, some deep, dark conspiracy. I mean, these are real people. We know who they are. It's Christine Lagarde at the IMF. It's Mario Draghi at the ECB. It's Janet Yellen at the Fed, Marty Feldstein at Harvard, Larry Summers at Harvard, Bob Rubin at the Council on Foreign Relations. I mean, they're real people with real day jobs, and they're actually not that opaque. I mean, they have websites, they put out papers, they give speeches. The difficulty is very few people actually read what they're putting out, and those who do, many don't understand it. It's very technical stuff. I happen to have the graduate degree in international economics from the same school that Tim Geithner went to. I have 2 law degrees, so I happen to be trained in all this, and I'm pretty good at interpreting it, but I don't expect everyday Americans to understand an IMF technical paper. Why should they? They've got more important things to worry about. But my point is, everything I talk about is out there. They've kind of announced what they're doing, so you can see this plan. So part of the plan is to use the special drawing right, that's this world money printed by the IMF, to reliquify the world in a financial crisis. Now, one of 2 things may happen. That may actually work to some extent. It'll be very inflationary if it does, but But that could work, but it would only work because people don't understand it. But my guess is in an age of social media, partly because of things like my book, the New Case for Gold, and other authors, people out there explaining it, people will see through it. They say, wait a second, I just lost confidence in dollars, euros, and yen. Why should I have confidence in special drawing rights? It's just another form of fiat money. When that happens, you're going to have a conversation about gold. Now, I guarantee, Greg, there's not a central bank in the world that wants a gold standard. Not one of them. Why would they? Money is power, and they control the money, so why would they want to go to a different form of money that they don't control, specifically gold? They don't want a gold standard, but they may have to go to a gold standard. They may have no choice. It may be the only way to restore confidence. If you do, if you have a gold standard, or even if you're using gold as a reference point, you have to get the price right. See, the minute you say a gold standard, what is a gold standard? Any gold standard, what is it? Well, it's some relationship between paper money and gold. That's all. We're not going to walk around with gold coins in our pockets. I mean, having physical gold coins is a good way to preserve wealth, but in terms of transactions, we're unless there's a complete societal breakdown, which could happen, but you don't have to hypothesize that. We're not going to walk around with gold coins. We'll probably have digital money or paper money. We're mostly digital these days. But some relationship between money and gold. But you have to ask yourself a few questions. What's my definition of money? Is it M0, M1, M2? Those are very different numbers. How much gold backing do I want for my standard? Do I want 20%, 40%, 100%? Who's in this club? Is it the United States only, or do we include China, Japan, Europe, and so forth? So those are all policy questions. And I don't pretend to know the right answers. I'm just telling you the right questions. So you have to answer those to do the math. But basically, here's a big pile of gold. Here's a big pile of paper money. What's that relationship? It has to be non-deflationary. If you set the price of gold in a gold standard too low, you're going to have to reduce the money supply to maintain the parity. That's going to be deflationary and depressionary.
That's what happened in the Great Depression.
That's exactly what happened in the Great Depression. And the guy who messed it up was Winston Churchill. And the guy who told him to raise the price was John Maynard Keynes. That's kind of ironic. People think of Keynes as this gold basher. But in fact, in 1925, Winston Churchill was not prime minister. He was chancellor of the exchequer, so equivalent of our secretary of the treasury. Maynard Keynes was an advisor. Churchill wanted to go back at about $20 an ounce in dollar equivalents. And Keynes said, no, that's a mistake. You doubled the money supply to fight World War I. You can't go back to the old parity. You'll have to cut the money supply in half. Keynes said you should double the price of gold, maybe to $40 an ounce. Churchill ignored it, went with the lower price that was deflationary, and it contributed to the Great Depression. So now monetary scholars know this. Ben Bernanke, Janet Yellen won't talk about it, but they know what I'm talking about because they've studied their monetary history. So you have to have a non-deflationary price. This actually segues into the other canard, which is there's not enough gold to have a gold standard. That's pure nonsense. There's always enough gold. You just have to get the price right. Now, at $1,250 an ounce, that's way too low. I mean, that would be deflationary, depressionary. That would not work. But at $10,000 an ounce, it works fine. So all I did to get to that number, Greg, is I used M1. Okay, that's a judgment. You could have used M0 or M2. I used M1. I used 40% backing. Again, that's debatable. You could have used 20 or 100. I used 40. I think that's conservative. If you use Europe, China, and the U.S. using M1 with 40% backing, it's 8th grade math. The answer is $10,000 an ounce approximately. Now, what's interesting is that if you change the assumptions and you use M2 with 100% backing, and I don't recommend that, but if you used M2 with 100% backing, that number is over $50,000 an ounce. So the implied non-deflationary price of gold, depending on your assumptions, is between $10,000 and $50,000 an ounce. Now, it's not going to happen tomorrow, but if you have a gold standard and you want to avoid the blunder of the 1920s, you're going to have gold at least $10,000 an ounce, possibly much higher. And again, I explain all this in my book, The New Case for Gold. The math is there, the history is there, the analysis is there. Everything we just talked about is all in this book, The New Case for Gold. So that's how I get to them. I didn't make it up. I'm not trying to get headlines. I'm not trying to scare people. I've done the analysis. And by the way, I spoke to Paul Volcker about this, and he agreed. He said the price of gold has to be much, much higher to have a gold standard. He wasn't advocating a gold standard, but he was acknowledging the math.
One of the things that I've heard you talk about in the past is that the Fed wants inflation. And last week, Janet Yellen spoke, and I don't know, maybe you can understand her. I mean, it's just goofy. It just sounds like she's not going to raise rates. They want inflation. Some of the Fed governors are out saying we need to hit our 2% inflation target. Am I getting this wrong? Does the Fed want inflation? You have brought that up before, that the Fed wants inflation. They're going to get inflation. Will you explain that?
Well, first of all, the Fed absolutely wants inflation. Now, they have an inflation target of 2%. This is no secret. It's in every speech, every press conference, every Fed statement. It's enshrined as official policy. They want 2% inflation. Now, it's kind of interesting why that's the goal. Why not zero? I mean, it seems to me you should want zero inflation. No inflation, no deflation. That's price stability. So then people can make investment decisions or hiring decisions or other decisions without having to take into account whether money is worth more or less. You have a constant money, and then you make your decisions based on your business prospects or other financial or economic conditions. But that's not what the Fed does. They don't target zero. They target 2%. Now, it sounds more what's wrong with 2%? We've seen worse. In 1980, we had 15% inflation. Between 1977 and 1981, in a 5-year period, cumulative inflation was 50%, 50. The value of the dollar was cut in half in 5 years between 77 and 81. So that's pretty nasty. So 2% sounds benign. But again, let's do the math, Greg. 2% inflation cuts the value of the dollar in half in 35 years. Go another 35 years, it's half again. So you cut something in half, take the half that's left, cut it in half again, you've got 1/4 left, which means that 35 plus 35 is 70 years, right? So in an average lifetime of 70 years from birth to death, the value of the dollar drops 75%. A dollar is only worth 25%, 25 cents on the dollar compared to when you were born. That's with 2% inflation. 2% inflation cuts the value of the dollar 75% in an average lifetime. You get into 3% inflation or 4% inflation, now you're talking about wiping out the value of the dollar in the course of an average lifetime. So what's so benign about destroying the currency by 75% in an average lifetime? That's what 2% inflation does. But the Fed's logic is, well, you know what? I analogize it to a little kid. He looks in his mom's wallet, and 9-year-old kid looks in his mom's wallet and he sees $100, and he says, "Well, if I take the $100, mom will know and I'll be in trouble. But if I take $2, she won't miss it." In other words, 2% is high enough to destroy the dollar, but low enough that people won't notice. So it's a kind of lie, it's a kind of deception. It comes out of the pockets of savers, but people don't really feel it at that level. So that's the theft that the Fed is perpetrating, and that is their target. Now, what's interesting, we're in an era of what I call Mick Jagger economics. Mick Jagger and the Rolling Stones had a song called "You Can't Always Get What You Want." The Fed wants 2% inflation, but they haven't been able to get it for the last 8 years. Briefly they did, but on average over 8 years, we're nowhere near 2% inflation. In fact, some evidence that we're bordering on deflation, and in fact in Europe and Japan and elsewhere, they actually have deflation. So, but governments cannot tolerate deflation. Governments cannot have deflation because it increases the real value of debt, increases the debt to GDP ratio, destroys tax collections. Because, if you and I make a certain amount of money one year and we make the same amount of money the next year, but prices go down, we actually have an increase in our standard of living. We're making the same amount of money, but if all the prices went down, we can afford more dinners and more gas in the car or whatever. So we have an increase in the standard of living. If you and I get a raise, what does the government do? They tax us. But if you and I get an increase in our standard of living from lower prices, the government hasn't figured out how to tax that. They don't know how to tax the benefits of deflation to consumers. So the government hates deflation because they can't tax it. They hate it because it messes up their debt to GDP ratios. They must have inflation. So we have a situation where the Fed wants inflation. I explain why. They're not getting it because velocity is declining, but they have to have it. So what does that mean for policy? It means they're not going to give up. They're going to keep trying. So whether it's QE4, negative interest rates, forward guidance, Operation Twist, currency wars, take your pick. These are all the tools in the toolkit. It's like a hammer, a saw, a level, and a plane. These are the carpenter's tools. They're going to keep trying until they get this inflation. And when that happens, you're going to wish you had your gold.
One last question, just for people saying, what should I do? I know you're recommending 10 to 20% of physical gold in your possession. Should people take money out of their bank? Should they be holding some cash because it'll work good if the system locks down like it did in Cyprus? like it did, and if you had some cash and you had some gold, you had your near-term covered and you had the long-term covered, what should people do now? Should they take money out of the bank to thwart a bail-in and have some cash? Should they be buying? I know they should be buying gold. What should people do?
Well, a good question, Greg. So I recommend 10% of your investable assets in gold. Let me define investable assets. So take your home equity, put it to one side. Take your business equity and put that to one side. So, if you have a pizza parlor, a dry cleaner, an auto dealer, you're a doctor, lawyer, dentist, whatever it is, that's your livelihood. So put your business equity and your home equity to one side. Whatever's left, those are your investable assets. Take 10% of that and put it into physical gold that you control, not in the banks, either private non-bank storage in a reputable vault operator or some other safe place. So put 10% in physical gold. Now, what do you do with the other 90%? I do recommend some cash. Cash gives you good optionality. My own portfolio, I have fine art, I have land, I have some private equity, I have some tech startups. I don't have any publicly traded stocks because I can see the stock market being shut down as it was before. But as far as kind of physical cash, like you stack $100 bills. I live in New England. We got whacked by Hurricane Sandy. There was no power in my town for 8 days. No electricity for 8 days. What does that mean? It means the banks are closed, the ATMs are closed, the gas stations are closed because you need electricity to pump gas. And supermarket scanners were closed. Some places had generators, but by and large, all the e-commerce was shut down. So, but if you have paper money, you can still spend that, and so it is good to have. It's just like having a flashlight and extra set of batteries, and like having an emergency kit. So a stack of $50 or $100 bills for those kind of emergencies is a good idea, but don't think that you can insulate yourself from the shutdown of the banking system by getting cash, because all right, $1,000 or whatever, that's helpful. But if you have $100,000 and you want $20,000 in cash, you can't get it. I mean, legally you can. It's perfectly legal. But go down to the bank and ask for $20,000. You will be treated like a criminal, a drug dealer, a terrorist, or a tax evader. Again, you're a perfectly innocent civilian. It's your money. It's 100% legal. But the bank is going to look at you like a criminal. They're going to file a currency transaction report with the Treasury. Some banks will ask you to come back 3 days later. They say, hey, we got to order the money. Really? What's up with that? They're going to want all kinds of documentation. They're going to ask you to sign stuff. And basically, they're going to treat you like a criminal, even though you're a perfectly innocent American citizen. So people ask me all the time, what's the status of the war on cash? And I tell them, the war on cash is over. The government won. So you're locked into a digital slaughterhouse. This is what negative interest rates are all about. I mean, the easiest way to beat negative interest rates is to get cash, but the government has to make it difficult or impossible to get cash so they can herd you into these what I call digital slaughterhouses so they can slaughter your savings with negative interest rates. So it is good to have some cash the same way you have flashlight and batteries, but I wouldn't really be able to count on getting very much. The good thing about gold is that it's not digital, it can't be hacked, can't be erased, can't be wiped out. Again, just put it in a safe place and you'll be fine.
Silver, a lot of people say, well, I wish you'd say something about silver. Your thoughts on silver as we close?
Silver will tag along. Look, silver is more difficult to analyze because it's not only money, it is a form of money, but it's also an industrial input, so it has some other factors. Gold actually isn't good for very much except money. It's the best form of money, but it's not good for much else. So it makes it easy to analyze in the money space. Silver does have these industrial inputs, but look, silver's going to be along for the ride. If gold goes up to $10,000 an ounce, silver's going to go up to $100 an ounce. There's no way that gold's going up and silver is not going up. I'm not saying there's a fixed ratio. There isn't. But silver will be along for the ride. By the way, a monster box, 501 ounce American Silver Eagles, that's like the battery and flashlight. That'll be spending money when the crisis comes.
James G. Rickards, best-selling author, a first-time author, first 2 books, bestsellers. I think you're going to pull the hat trick, my friend. I just want to put this up here. Again, this is the new case for gold, James Rickards. You can see the beautiful golden book cover art here. The new case for gold, James Rickards. James Rickards, thanks for joining us today on USAWatchdog.com. And incidentally, I will put a link for the buying page or your website for the book for you YouTube people. It'll be at the bottom. It'll be also in the after the interview section. James Rickards, thank you for joining us today on USAWatchdog.com. The new author of the new book, The New Case for Gold, just out yesterday. James Rickards, thanks for joining us today on USAWatchdog.com.
Thank you, Greg.